Good afternoon, everyone. It's Friday, March 3rd, 2023. I'm Dave Weisberger, the CEO of CoinRoutes. It's time for This Week in Crypto. And while it would be interesting to spend all my time talking about last night's price action, the reality is over the last week, there really hasn't been a lot of movement. Bitcoin was slightly up going into last night, and now it's 3% down. But the price movement is really nondescript. We're in the same trading range we've been in for both Bitcoin and Ether. And volatility, with the exception of a 14-minute period last night, has been relatively muted. That said, this has been a huge week for news, and I think we're going to spend most of our time talking about that. Everything will start, of course, with Silvergate Bank. Basically, we have a bank that was one of the pioneers, if not the pioneer, in banking crypto firms having serious issues. They self-reported those issues that they were having problems in terms of maintaining their capital ratios, and that triggered a run basically from all the rest of the crypto firms saying that they weren't going to use them. Note, no depositor has been harmed, no one has lost any money, and realistically speaking, everything is working as normal, except they lost a lot of confidence from depositors because of various regulatory and other inquiries. Now, I am not going to defend the people involved. I am not going to even opine on the people involved. What I can say is there was no real contagion effect to the industry. There was no harm to any of their depositors, but maybe they will need someone to buy them out from their technology, or maybe they will just fail, or maybe that they'll succeed. I don't know what. But what I can say is when all the news was out in the market yesterday, for about 6 to 8 hours, there was no reaction. And then while there was a sell-off last night, that sell-off was extremely well contained. And I described it in another video, actually, because I actually think it was most likely a momentum ignition manipulation event. But what's important about this is it's part of a larger story of regulators potentially going after the crypto industry. And we're seeing this in many ways. We're seeing everything from letters from senators who are afraid of crypto and that it represents a disruptive technology that will stop the banks that are their biggest donors or biggest political foils from making economic rent, sending letters to Binance and doing all sorts of things. And it's always used by regulators to try to justify more draconian action. So what are the other pieces of news that went along with this? Well, first, there was a major story broken by Forbes, which turns out to have been really old by the time it was done. They accused Binance of having $1.8 billion in unsubstantiated funds. Now, even Forbes will tell you that those funds are right where they're supposed to be now, but evidently during last summer, there were some idiosyncrasies and some issues. Perhaps there's smoke there, perhaps there's fire there, I do not know. What I know is there's nothing proven that there's any risk to anybody's wallets or anybody's assets. Now, will that be the case? I don't know. I've said this before. I have no personal information, but it's fascinating how these become major news stories without actually knowing what the hell the impact is. Another interesting story is FTX. Well, what a surprise. Turns out that they probably did steal over $8 billion because now we have an $8.9 billion hole in their balance sheet. Well, we understand and understood that they appropriated the Bitcoin, the Ether, and the dollars and sent that over to Alameda. But what was not as well understood was just how bad it was. And this week, Mr. Ray came out and said, yep, there's an $8.9 billion shortfall. Essentially, this doesn't change anything. All it means is that all of the speculation, which I have done, that this was degenerate gamblers at Alameda trying to keep doubling down to make their money back, failing, and eventually running out of funds to steal. I think that's what we've seen. The fact that part of those funds were stolen to fund politics and political donations on both sides of the aisle, the fact that Politico and others have reported on this, it's a big story because essentially FTX was the only regulatory, quote, compliant exchange, or certainly looked that way to the regulators, is a real black eye for oversight in this country. Turns out that you may not be able to buy love money, but you certainly can buy political power. And that's something that is unraveling now. My suspicion is that when it unravels for good, we're going to actually learn something. But we'll see. The next story that was fascinating is the SEC, as people might remember last week, stepped in to say that Binance US shouldn't be allowed to buy Voyager's assets. The part of the story was the judge who's actually overseeing the proceedings slammed the SEC, basically accusing them from harming the investors who are the creditors in this case, and saying that you shouldn't be able to say you have to register when you give no path for registration. Let me repeat. The judge said what I've been saying all along, which is that the SEC's approach of enforcing rules that literally cannot be followed if you're a crypto exchange or a crypto company is absolutely disastrous for investors. And in this particular case, is harming investors who have already lost money and are just trying to get some of it back. He called it various adjectives. I'll just say that from my perspective, it's reprehensible. And it's something that is really interesting to see. At the same time, also in the news, we had former CFTC Commissioner Quintens and basically saying everything that I've said as well about how the SEC is harming innovation, how they're making less of a chance for compliance, and they're harming the very investors that they're sworn to protect in such a way that one could basically say that they're not doing their job. It's malfeasance and probably should be looked into. So all of that has happened this week, and it's fascinating. Yet the stories that we're reading in the press continue to be one-sided. We continue to see the Wall Street Journal has an article about Tether in 2018, and the stories on the banking side are getting more and more interesting. People are genuinely afraid in the crypto industry they're going to get cut off from the banking system, despite actually working to try to make a better financial system. So where are we? We are still in the stage where, first they laugh at you, then they ignore you, and then they fight you. We're clearly in the fight you stage. What will happen next is then we will win. But to do that, we are going to have to keep the pressure on, keep making our regulators accountable, keep talking to the Congress and your legislatures if you're in a different jurisdiction to make sure that people understand that regulatory clarity is important. I've said it before, regulations to make disclosures of risk absolute, make people ring fence client assets and allow them to protect those client assets from creditors, including the SEC, by the way, to actually enforce and surveil for manipulation. And the video I did earlier today on that is understanding part of what could be done. And fourth, to enforce customer protection rules like best execution, where people actually know what they're buying is at a reasonable price. Those things make sense. And very few people in the crypto industry dispute that. Yet we have a regulator who essentially is eschewing all of those principles on the theory that if they can get everybody to be afraid and shut down businesses, that existing financial firms can run crypto the same way. Well, guess what? It's a different asset class with different technology and different market structure. And trying to make those two things together is actually very, very wrong, will harm innovation, set the US economy back. We've talked about it before. I'm going to continue talking about it, but that was this week. So stay safe out there, and we'll see you next week.